Welcome to the Explainer. We're jumping right in today because we are tackling an absolutely critical mission, taking you from being an emotional, reactive trader to a highly structured, evidence-based operator. For those of you who are newer to this, we're going to focus entirely on how to build a simple, bulletproof record of every single trade you make. It's a real game changer, so let's get into it. You know, there is this profound saying floating around the trading world, and it hits the nail right on the head. It goes, most traders don't have a strategy problem. They have a memory problem. And think about it. When you're dealing with a fast-moving market where leverage literally magnifies everything and unexpected news events can flip the price direction in seconds, relying solely on your memory? Yeah, that's just a total recipe for disaster. The market gives us way too much room for self-deception if we don't have the receipts. And that lack of evidence leads us straight to what we call the Friday guess. We've all been there, right? Your broker gives you these endless rows of numbers, you've got screenshots saved in some random desktop folder named MISC, and your actual notes are scattered across 3 different apps on your phone. So by the time Friday rolls around and you're reviewing your week, you are literally just guessing why Tuesday went so horribly wrong, because you've completely lost the context of the moment. Those little behavioral leaks in your trading end up surviving quarter after quarter, just quietly draining your account. Now, we need to clear something up right away. There is a massive, massive difference between looking at basic broker history and actually building a true review habit. Sure, your broker provides you with profit, loss, entry price, and exit price, but honestly, those are just numbers without the thinking behind them. Simply scrolling through your trade history is not the same thing as a review habit. A genuine review habit gives you the full context. It's literally the only way to isolate exactly what is working for you and, more importantly, kill the leaks that are costing you serious money. Okay, so here's a huge trap we have to avoid at all costs. Outcome bias. This happens when you judge the quality of your decisions solely based on whether the trade made money or lost money. But listen closely, because this is absolutely crucial. A winning trade doesn't always mean good execution, and a losing trade doesn't always mean bad execution. You could break literally all of your rules, take a totally garbage setup, and still get rewarded by sheer luck once. If you're only reviewing your profit and loss, outcome bias tricks your brain into rewarding some incredibly dangerous habits. So, how do we beat that bias? Especially if you are a newer trader trying to build this habit from scratch, you need specific, actionable context. It's got to be more than just writing down your entry and exit prices. You need to record the currency pair, record the trading session, because, a setup that crushes it during the London session might just completely fall apart during the Asian session. Track your specific technical reason for entry, the exact setup type, and your actual risk compared to the risk you planned for. If you actually want your journal to improve your trading, you have to track the decision-making process behind the trade, not just the final result. And this brings us to one of the most powerful tools in your entire arsenal, screenshots. A written note is fine, but screenshots, they show the unvarnished truth. Like we said earlier, your memory will totally lie to you. It'll tell you a setup looked absolutely textbook perfect at the time, but when you pull up the screenshot later, you might clearly see that you were just chasing the price, or maybe you completely ignored a massive resistance level. You need 2 screenshots for every trade, one right before entry to prove why you took it, and one after you exit to show exactly how you managed it. Which naturally leads us to perhaps the most powerful gut check question you can possibly ask yourself. Am I trading well, or am I just hoping? A proper, structured journal forces you to answer this honestly. You have to look at the mirror and ask, are my entries based on a defined edge and a proven strategy? Or are they just based on raw emotion, FOMO, and this desperate, crossing your fingers hope that the market will just magically go your way today? You can usually tell the difference just by how the entry rationale sounds out loud. A strategy-based entry is highly specific. It sounds like price swept Asian session liquidity, returned above the range, and confirmed a reversal. Boom. That is a repeatable process. An emotion-based entry, on the other hand, sounds more like, well, I just felt like it was going to go up, or honestly, the worst one of all, I just really wanted to recover a previous loss. When you start keeping a structured record, it will quickly and ruthlessly reveal if you are running a legitimate trading business or if you're just randomly gambling. We also have to acknowledge the human element here. Let's be real. Forex trading is an incredibly emotional endeavor. You can literally have the most perfect, textbook technical setup in the world sitting right in front of you and completely ruin it with fear, greed, or just simple impatience. That is exactly why emotional tracking absolutely has to be a core pillar of your trading journal. You must track how you feel right before you enter, how you're feeling while you're sitting in the drawdown, and how you feel immediately after you close the position. So what does that look like? You should be actively recording states like calm, rushed, frustrated, anxious, or bored. And why do we do this? Because after just a few weeks of tracking this, patterns are going to emerge. You might discover that your calm trades have a massive 80% win rate, while trades you take when you feel bored or frustrated are consistently producing your absolute biggest losses. That is invaluable data. It tells you exactly, mathematically, when it's time to just walk away from the screens. But, and this is a big but, you only get that quality data if you are brutally honest with yourself. Don't just write down bad trade. That helps no one. Record the actual specific mistake. Actually, scratch that. Record every mistake. Did you move your stop loss because you were scared? Did you revenge trade? Did you completely ignore major news risk on the calendar? Did you increase your lot size right after a loss trying to win it back? Look, it is super uncomfortable to document this stuff, but if you record these honestly and see the exact same mistake 10 times in a month, it is no longer just a random error. It's a pattern. And once you clearly see the pattern, you can build a hard, unbreakable rule to stop it. It is also absolutely crucial to remember to review your winning trades too. It's not just about the losses. Winning from skill means you had clean execution and you properly managed your risk. Winning from luck, though, that means reckless behavior and breaking your own rules. If you don't aggressively review your winners, you might end up building massive, unchecked confidence around a terrible habit, just assuming the market will keep rewarding your recklessness. Spoiler alert, it won't. You need to always know for sure if you won from skill or just got lucky. Let's pull this all together and look at what a multi-dimensional trade record actually looks like in practice. As you can see, it's way more than just numbers on a spreadsheet. It tracks a specific setup, like a breakout and retest. It tracks the mood. Calm at entry, anxious during pullback. It notes the final financial result, sure, but most importantly, it captures the lesson. Setup valid, but closed partials early out of fear. This approach tells the full, honest, beginning-to-end story of the trade. Now, to make this a habit you will actually stick to long-term, we look to the Gaphy methodology. It is beautifully simple, based on 3 steps: connect, capture, review. You've got to keep it low friction. Whether you're using a basic spreadsheet or dedicated journaling software, you want one single clean home for all your trades. You capture the vital context that your broker completely misses, those screenshots, and your mood, and then you review it all to find your true edge. No unnecessary ceremony, no overcomplicating it. Because a complex journal that you eventually start skipping is way worse than having no journal at all. The rhythm of how you use this record is what makes the whole system work. Daily journaling captures the gritty details while they are still fresh in your mind. But just blindly collecting data, that isn't enough. The real magic happens at the end of the week. The weekly review is what actually reveals the broader patterns. Sitting down on the weekend with a clear head to analyze the data you collected is exactly where you turn a bunch of random trades into highly actionable intelligence. During that weekly review, you want to ask yourself the tough questions. Which setup failed the most this week? Was I truly disciplined with my risk? Did I revenge trade on Thursday? Look at all your data, but here's the real secret trick. Do not try to fix everything all at once. You'll just overwhelm yourself. Pick just one single behavioral leak to fix for the following week. That's it. Maybe next week your one and only goal is having patience for candle confirmation. Small, hyper-focused improvements, repeated week after week, literally change everything. And that brings us perfectly to the core mantra of this entire explainer. Trade, record, review, improve, and then repeat the whole shebang. This isn't just about maintaining a spreadsheet. You are building a closed-loop feedback system. This is the exact loop that turns raw, chaotic trading experience into actual, measurable trading improvement. You finally stop guessing, you stop relying on fading memory, and you start operating like a true professional. So, I'm going to leave you with this final, provocative thought. The next time you sit down at your desk for a trading session, ask yourself, will your future trading decisions be based on hard, undeniable evidence, or just a fading emotional memory? The choice is entirely yours, but only one of those paths leads to long-term consistency. Don't wait around on this. Start building your ultimate trade record today. Thanks so much for joining me on this explainer, and I'll catch you next time.